Happy Wednesday out there, Team 42. It's your skipper here, Darius to present our macro minute for Wednesday, September 4th, 2024. As always, we'll start with the executive summary from today's leadoff morning note. If you would like to review the analysis supporting these conclusions, as well as what specific changes you need to make in your portfolio to remain on the right side of market risk, you need to be a client of 42 Macro. So today's key macro questions are: how fast will the yen carry trade unwind occur? Will U.S. growth data support asset markets or fan the flames of yen carry trade unwinding? And is our green shoots globally theme intact? Our answers are: recent cross-asset performance is consistent with our Goldilocks with deflation characteristics hybrid market regime, which calls for defensive leadership amid general uptrends in the equity and fixed income markets. For our latest around the horn, the fact that the Goldilocks versus deflation debate has taken this long to resolve amid a bevy of bullish data points and policy updates since early August implied that there was likely to be some seasonal volatility in September and perhaps October. It appears yesterday was the beginning of that seasonal volatility. Any signs of a faster than anticipated deceleration in U.S. growth is likely to cause more pain in asset markets in this bad economic news equals bad news for markets regime. Our fundamental outlook suggests Goldilocks is likely to eventually win the debate and perpetuate a year-end performance chase. The August composite PMI data from around the world were generally confirming of our green shoots globally theme. Transitioning to our 42 macro dashboard, as always, we'll wrap up with the question from our community. This one's regarding global easing and pressure on the JPY carry trades, the yen carry trade. So, hi Skipper, thanks for all the insights. Have been following your carry trade Japan research recently? I'm quite worried about the curve steepening in the U.S., which could also pose pressure on the JPY as it historically had in 1990s, 2000s, 2007, and 2019. Would you think the potential unwind in carry trades could lead to some structural risk down the road, as it is very hard to estimate cross-border financing? Much appreciated. Thank you. The short answer to the question is certainly yes. I mean, we've had four years in a row of really aggressive capital inflows into the United States economy. I want to say on a share of GDP basis, the cumulative inflow that we've seen in terms of capital inflow since the end of 2020 in the U.S. economy has been the largest inflow we've ever seen into the U.S. economy. It was such a outsized, kind of one-way steady stream of flows into U.S. capital markets. And so if we did see a repatriation of that flow stemming from a steepening of a bull steepening in the U.S. yield curve, which is typically what you see in a recession, then obviously it would cause some structural risk. But again, we're only going to have more bull steepening if we go into a recession. And again, we don't believe a recession is the highest probability outcome in the U.S. economy over the medium term. And so do I see, will it cause risk if it continues? Yes, of course. I think that's the general takeaway in the context of the capital inflow, the starting point capital inflow dynamics. But again, I think to see a significant bull steepening from here in the U.S. yield curve, you would have to almost certainly have a U.S. economy that is in or near a recession. And again, we just don't see that as the highest probability outcome at the current juncture. So I will wrap it up there. Darius presenting our macro minute for Wednesday, September 4th, 2024. Everyone have a wonderful day out there. Best of luck. We'll catch you back here tomorrow. Cheers.